Welcome back to the Capital Mindset Show, everyone. I'm coming back from vacation. I'm a little under the weather because, that vacation, you got a little sick, but otherwise pretty good. So I hope you guys are having a great weekend. We're going to start off the week early, or I guess, with 3 stocks of interest. So a little bit longer video. We're going to be analyzing, as you can see, 3 different stocks, beginning with Micron. So Micron Technologies has been asked about a lot. I've covered it in the past. You guys can check out the content library to see my past thoughts on it. My past thoughts were pretty much in summary. Company looks good, just price wasn't good. A lot of super investors were invested. I want to take the time here to highlight why you should not be influenced entirely by super investors or the action of super investors. I remember people saying, well, this person bought, I'm going to stick to them. That's all well and good. I could have been wrong, right? I could have been wrong about whatever. And whatever. I think that everyone needs to kind of take inspiration from them, and then from there kind of map out, well, what do I think? Well, if you look at it from a PE basis, a lot of retail investors are going to look at that and say, oh, look, it's cheap. 7.4 PE, extremely cheap. They actually started a dividend policy more recently, so it's sitting at about 0.68%. Micron Technologies over the past, I guess, couple years, we take a look at that 1 year, is down 29.50%. 5 year, it is up 96.85%. Pretty good performance over that time period. Now, the company does share it has some key competitors, which we'll actually talk about right now, which, these are the breakdown in terms of market share for DRAM. And we have Micron sitting at about 23.5, Samsung at 41.7, and SK Hynix, is sitting at about 29.4%. Doesn't add up to 100, as you can see, because of rounding. So keep that in mind. Now, this is 2020's data. It's basically more or less around the same for 2021, which is actually the numbers we're going to be looking at because 2022 hasn't finished yet. And we actually take a look at their financial statements. We'll actually see what's going on in terms of their assets. So we see cash and cash equivalents. Pretty strong position, 7.7 billion there. Now we look at long-term debt, 6.6 billion. They have enough cash to pay off the debt. Pretty easy there. Now, in terms of other stuff, we do see some goodwill. They made some acquisitions, all well and good. Now, let's look at the statement of cash flows. On the statement of cash flows, we are seeing net cash provided by operating activities about 12 billion. Expenditures for property, plant, and equipment. It is a very capex-intensive business. They're generating around 2.4 billion, around there in terms of free cash flow from that given year. Net income, however, sits about 5.8 billion. So already right there, the company does appear to be a tad bit more expensive than previously looked at. Now, this is actually, when you get down to it, the reason why their cash or net income differentiates itself so much is because we're looking at cash leaving the business and on the accrual basis of accounting. Did I say cruel? Accrual basis of accounting in terms of GAAP net income. So when you take all that into account, we might see some differences there. Overall, business doesn't really show any signs of complete and utter weakness. Now so we plugged in Micron to the valuation model. I just want to highlight some things. So we're going to actually say that on the aggressive side, let's put it at 20% just to kind of make a point here. So if they grow at 20%, we're pretty much in the green there. 10% is probably where more or less they might grow. Somewhere between 10 and 20 is where I would assume it to be. That's if we just require a decent margin of safety, but not a massive amount of margin of safety. So I see the value here because 10%, some might argue, is very conservative. But I'd probably say, yeah, that's probably the case. I think that we kind of can see an 8% and below, maybe. But a lot of super investors are probably looking at this. When I looked at analysts, I saw anywhere from 13, 15, 17% in some rare instances, all the way down to around 8%. So just kind of highlighting there. According to analysts, though, we do have a price target, a buy rating, a price target of $77.92. You can see up there, indicating about a 32.56% upside. If we actually look at the revenue, cash flows, and shares outstanding, it's all pretty cyclical. It's all indicating a cyclical business. Should be no surprise if you guys are looking to invest in the DRAM space. You should know it's cyclical. You should also know it's mostly commoditized. Again, if we remember that breakdown by market share, DRAM is DRAM is DRAM. So just remember that, or RAM is RAM is RAM, whatever you want to say it. So just to highlight this again, DRAM. So kind of going off from there, that's pretty much all I want to discuss with Micron. That's the quick and dirty update here. I'm also going to take you guys into Verizon. So with Verizon stock, we're going to actually visualize it here. I'm pulling it up. In terms of Verizon, there are a lot of key aspects I actually want to discuss, and some of the key aspects will require the whiteboard, so I'm going to take you over there before we continue. So So Verizon is otherwise known as a utility. So utility. So utility company. And some key aspects about a utility company can include, safety. So that's a benefit. We'll put a benefit, safety. But a negative, sometimes some people attribute as low returns. In some cases, not all cases, in some cases. All right, so safety, but low returns. So people assume that you're getting some degree of safety with low returns. But I want to actually very much distinguish the difference between a traditional utility, like let's say Duke Energy, so DUK, versus something like Verizon. All right, so Duke Energy is a regulated utility to the point where they basically have localized monopolies, so local monopolies. I'll just put it as M, local monopoly. So you know verbally what M means, monopoly. Verizon is not a local monopoly. There's nothing stopping me from saying I'm at AT&T and I'm going to go to Verizon or vice versa. Verizon has mainly been investing in their infrastructure, and I kind of want to map this out because this is very important to distinguish. So infrastructure spending, I will label it as I. Infrastructure spending is very necessary. So they take on a lot of debt, right? So they take on debt in order to do this. And what are some key risks that might be associated with that? Well, we know that rates are rising. So interest rates are rising. So if they ever need to refinance that debt or invest in new projects, it gets more and more expensive, increases the cost of capital. For them, it's going to be very important to kind of control that. And that's going to be a big key factor there. If the interest rates for their debt kind of rise beyond what their shares are, trading for in terms of a yield, they might be more inclined to issue a lot more shares. Verizon has not been a buyer of shares. They've been actually more of a issuer of shares. So if debt kind of increases in cost, they're going to be stuck between a rock and a hard place. They're going to need to make those investments anyways to kind of keep up with competition as well as advance forward. So this is a must. They have to take on debt. There's no choice here. And one other key aspect is if costs rise. So remember that inflation thing? Well, costs can go up. So you might be saying, wait a minute, costs are rising. They're utility though. We get that safety. Wrong. You're assuming a 1-to-1 ratio exists. So as costs go up by 1%, the cost to the consumer or their consumer go up by 1%. This isn't necessarily the case. You can compare the price of cell phone plans over, a while. They don't go up that much. And you also have to compare, there's a lot of competition. And cost is obviously a concern to the consumer. Cost can only go up so much before the consumer rejects it. However, the production costs on your end are going to go up, and maybe you can try to reject it. Maybe you don't reject it. It all just depends really on the situation. What I'm trying to say there, not that simple. So there's some risks there. Costs can rise faster than what you can charge your customer. Yeah, that can happen. So when you consider that or take that into account, you start to appreciate the overarching risk factors associated with Verizon. Now, this is a company that Warren Buffett invested in. Another highlight that, similar to something like Micron Technologies is just because a super investor invests in it doesn't mean you have to agree with it. I think he has been selling it more recently. This is a stock that I vocally come out and said, I personally disagree with Buffett. Doesn't take away from anything else he's done, anything like that. Just my personal opinion that I disagree with them, especially under the context of the liquidity crunch. I think that Verizon is going to, struggle a little bit. A lot of people are kind of flying to this company for safety. If we kind of remember the price action here, if we look at the 1 year, it's pretty much gone nowhere. In a lot of instances, and not in a lot of instances, almost definitively, it has outperformed the market because it's gone down less than the market. But over the 5 year, it has not gone up as much as the market. People associate this with a bond-like proxy. Well, I'd say that there's a hidden risk here, and that goes with investment in their infrastructure. Let's say a technology kind of comes up and, it disrupts the whole sector. So they face disruption. So I'll just put for disruption. I know that's not Disney stock, but disruption. So with disruption in play, they have to take on more debt, right? More debt to kind of match that investment to kind of not be disrupted. Well, what are they in a position in? Well, let's actually take a look at their financial statements, and we'll kind of be the judge of that, whether or not they're really in a position to do something like that. So let's go here. Let's move you guys over there. And we see that, okay, cash and cash equivalents, they have $2.9 billion, down from $22 billion in the year before. This is their 10K, by the way. And so we kind of go down the list here, and let's take a look at that debt. Oh, that long-term debt's at $143 billion, up from $123 billion, which I'll show you there. Not looking too good. So imagine if they have to invest in a whole other array of infrastructure to kind of keep up with, competitors, new technologies, etc. This is a hidden risk that really isn't reflected in the numbers. The numbers only reflect the status quo. The status quo remains, and they continue to make those investments, high barriers to entry because you have to invest so much in CapEx in order to kind of get to where they are. This is why we saw the merger between Sprint and T-Mobile. They argued this to regulators. They said, hey, in order to compete with Verizon and AT&T, we need to be one big, larger entity in order to invest in that CapEx. This is, of course, assuming that there is no disruption to take place. I'm kind of going off of those offshoots, pie in the sky ideas like Starlink. Not necessarily pie in the sky. It's probably the wrong word for it. But let's say that works out. What does that mean for companies like Verizon, AT&T, T-Mobile, Sprint? What happens to these companies? Well, it's yet to be seen. They have a lot of leverage. We already talked about the risks associated with, them having to take on new debt, to refinance their debt at higher interest rates, how that's going to affect them. It's going to have a negative effect, to say the least. So we got to consider that. So if we actually go back to the evaluation and we plug in VZ. So Verizon has a strong buy rating of about $53.06 or 60 cents, implying a 5.18% upside, basically fairly valued. The company is basically priced for nothing. I think that these growth rates are absolutely ridiculous. It won't grow that much. In reality, remember, these are the growth rates from the previous stock. So in reality, I think a high end is going to be maybe 12% on a high pie in the sky assumption. But I think it's going to mainly grow at really a high rate of 10%. And 8% is a possibility. 5% is also a very strong possibility. And stagnation, I'll also leave it at a possibility. Really, in reality, some of those risks that I kind of talked about really aren't priced in at all. If they ever occur, you could see this company greatly suffer. Okay, of course, maybe it doesn't happen. Maybe it doesn't. All right. And by the way, we are maintaining a normalization or normalization. So remember that feature that I have. I've normalized the cash flows because of that 2021 dip. And shares outstanding, it does appear, again, that they are a serial issuer of shares over time. They don't really buy back shares. Oh, well and good. We won't really punish them for that. Return on equity is pretty strong. Altman Z-score does not understand if they're going to go bankrupt. The model's own indicator also doesn't understand it either. And that's because, again, tons of debt. Tons and tons and tons of debt. So that's basically what I want to highlight with this. We're going to move on to the next stock, which is Disney. So Disney stock is interesting because we've covered it in the past. People have said, okay, they didn't like originally our old analysis of Disney where the stock was trading really high and, we were a very small fledgling channel. And the company was, couldn't do no wrong. I think it was around here, actually. It was it was around here for sure. So this is actually where the company was trading at when one of the first videos came out on Disney. And yeah, we said overvalued, completely overvalued company. It was very easy to see it back then. I don't know why it was not obvious. And now we're kind of seeing it at near pandemic lows. The company has basically gone nowhere for a very long time. Since around here, we can say. So from 2015 to 2022, this has been a terrible investment, garbage investment, in fact. So some people, this has a cult-like following. This is one of the few companies I would say that can absolutely do terrible things to their fan bases, and the fan base will come back. I got to be honest, companies like that intrigue me. There are very few companies on this earth that I can identify that can absolutely do questionable things to the rear ends of their fan bases and still get away with it and make absolute buttloads of money. Disney's one of them, and there's one other company I won't discuss here. But Disney's definitely one of them, and despite all, the fans out there who are disgruntled with a lot of their products, they still buy it, they still pay for things, they still watch it, they still subscribe to Disney Plus to see it. At least the majority of them do. And remember, Disney kind of markets to like the normie audience. So at the end of the day, as long as they're making money, who cares what you think? You should care about what the wider audience believes, as in the normie population. If the normie population likes something, and they're paying for it as a business, investor, etc., you're going to care about that. That's what you're going to focus on, not the rest. The rest is just noise. So we're going to kind of identify and see if that's the case. So we're going to go to the financial statements of Disney and kind of discuss it a little bit here. So if I go here and then kind of just take us down there, we're going to go down to the statement, not statement of cash flows. First, let's go to the income statement. Let's see if we can kind of spot anything weird here. Not really. In terms of actual revenues from the whole years, it hasn't really declined too much in terms of services, products either. Total revenues really kind of remain stagnant all in all. And if we actually see the net income took a massive hit. So we all know what happened. The pandemic happened. All in all, things kind of got a little bit rough. Cost of services have been rising and revenues have stagnated. So keep that in mind. They're having a little bit of pricing pressure there. Now, assets or balance sheet over here, we're looking at the balance sheet. In terms of current assets, we have cash equivalents about $15 billion. Receivables, remember, I've talked about this in the past. Disney's going to invest, I think it's like $33 billion in content. Remember, they have a recapture event. I made up that word, recapture event. You hear anyone else say that word, I made it up. So they watched my video and they took my word. But the recapture event, they actually experience that. Warner Bros. Discovery experiences that. Netflix is going to experience that. That's an advantage that I've identified that they have that we need to also consider. They have the parks, et cetera, and all that stuff. So we actually take a look at that long-term debt, which we see down there in the borrowing section. We see that they have a massive amount of debt that they've accumulated, and this is actually because of the pandemic. So they're now at about 52, now to 48. They are paying down that debt. And so a big problem with that all in all is I believe this kind of shows, again, kind of that not permanent damage, but severe damage to the balance sheet. And so we have to consider that when we actually evaluate the company. It's not the same company that we saw in 2019. In some cases, it got better. In other cases, it got worse. And I'm sorry, that's just the case. Now, what's something that some people might consider to be a red flag? Look at that goodwill. That goodwill sitting at $78 billion. That's a lot of goodwill. So that basically, in accounting terms, is what they basically overpaid for companies or acquisitions. And this is known as accounting goodwill, not economic goodwill, not to be, those are two separate things, okay? It can be confusing, but not really. So keep that in mind. Cash flow is a little bit different story. So on cash flows, we do see that cash flows are pretty much abysmal, right? It fluctuates. Sometimes they're negative, sometimes they're positive, sometimes they're barely positive, sometimes they're more positive than others. So when we go to the evaluation, I assume we're going to see kind of a poor job here. So let's plug in Disney into the model and see what it spits out. So as far as Disney goes, Disney has a strong buy rating, $178 price target according to analysts because they're such geniuses. Again, I want to be careful how I say that because it might be like misconstrued that I dislike analysts or I think they're silly or stupid or anything like that. No, I don't think that. So I think that, analysts have a place. They always have a place. There's jobs. They pay a lot of money in some instances. So, all well and good. Analysts have their opinions, and we can have our own opinions too. We can kind of see that we're kind of in an anomalous year. So the estimates are actually to rise according to analyst estimates. And again, same thing with shares outstanding. You can see that those buybacks they were doing completely wasted. They issued the shares again. Revenue up and to the right. So what we're going to do is we're going to normalize these cash flows, which they're already are normalized, and we're going to count for some anomalies. So when we count for the anomalies, then we can kind of get our pencil out there. But what we kind of get there is that we are not really at a price point that is essentially very attractive for me. So I'd have to assume a pretty strong growth rate in cash flows going into the future. But all in all, I think that it's questionable to say the least. I think that if you kind of lowered that margin of safety, it kind of makes sense if you are thinking that they're going to grow at higher rates. And this is, again, all depending on how you pencil out the numbers. But yeah, so if you think they're going to grow probably like, let's say 20%, something crazy like that. Yeah, you can see there. If we lower margin of safety to like what? Well, we lower margin of safety even more. It's not really looking good for this company. The company, all in all, kind of makes sense why. Well, there's a lot of question marks in the air. Can they increase prices on their services so that they have or they show and exemplify that pricing power that they may have with the consumer? I think that that's a possibility. We might see some excess growth coming out of that. We also might see some excess growth coming out of their various content strategies that going into, for example, royalty agreements. Hopefully they don't destroy a lot of their brands along the way. Maybe I'm wrong, and then they actually can kind of shaft their fan bases in some degree with some pushback. But from what I see, most of the time, not really. It doesn't really matter what some core fans agree on or say about particular fandoms. It doesn't matter. What matters at the end of the day is that they sell those tickets, they sell that merchandise, they sell and when I mean tickets, I mean both for the movie theater tickets and the park tickets. So, and that they can kind of upsell you on these other experiences, however they might be, and they get your kids to go. So that's the best part. They get your kids to go, they're all well and good. Now, what is really going on here? Well, I think that if I had to guess, analysts are kind of probably estimating that we do see a reduction or increasing cash flows in excess of what they previously had, because what's going to happen is they're going to reduce that expenditure that they previously were having, and that they're going to, get back to a normalization. So we can actually probably experience, when we normalize it out, a higher percentage rate of growth, somewhere along the 15% range. So let's go ahead and plug that in. If you believe that's the case, you're already there. Remember, we don't really have a margin of safety here. So if we actually start to boost up that margin of safety, we start to get to, some questionable experiences. Now, let's say we want to make separate adjustments. We want to say we're going to go off of analyst estimates, and we're going to say yes for next year. Right? We're going to start with this, and we're going to actually plug in their assumptions in terms of, and I got to show you what I'm doing. So I'm basically going over here, and I'm going off of analyst assumptions, and we're going to press enter. All right. So when we go off of analyst estimates, and we consider that like a base rate, okay. So if that's the case, we see how that's actually changed the assumptions, or it's changed our analysis. It actually says, we can be a little bit more conservative. So let's go off of analyst estimates there, just for the sake of argument. And so, we go off of 15%. There we go. We're almost there for that 15% growth rate and good, decent margin of safety. We're not too far away. So it's not crazy. I'd say that the price is way better today. Way, way, way better today than it was when we originally did the first video. So there's a massive improvement here. Is it a company that I'd be buying in my portfolio? Not really. I've already made my play in terms of content or content streaming. It's Netflix. That's the one I'm going with. Disney, I can see it why some people might want to invest in it. Not for me. Personally, not for me, but I can see why other people might like it. There's a lot of things to like about Disney. They have a lot of exposure to various other parts of the entertainment space, royalty agreements, all that jazz. Very powerful company. They control a lot of news media, etc. Very interesting assets they have all over the place, all over the world. Sports with ESPN, resorts, parks, etc. I get it. All right. So, with that being said, that it's not a company that I'm going to be adding. Really, none of these companies I'm planning on adding. But the one I find the most interesting, if I'm being honest, is Micron. So with that DRAM, even though it is a more commoditized, it's not as much as it is in the past. They're improving on that. I want to highlight that. But all in all, I think Micron's the most interesting of these three. Love to know your thoughts down below on which one's your favorite. But remember, as always, guys, the way to make money in every market, the way to become rich, is to invest in vegan food companies that are also crypto brokerages that offer 9% interest, risk-free, link in bio, make me rich, grift, and electric cars, robots, Mars, to the moon.